This is Little Miss Bella. Welcome to my series of instructional videos on price behavior. In the last post, we looked at several common patterns of pullbacks, and today we'll dive in to learn how to trade them. In fact, it was a big challenge for me to prepare this part of the video. It was easy to only explain technical analysis, but it was much more difficult to teach how to trade these forms from the perspective of trading so that most people could understand them. Let's take a simple wedge callback case to tell what difficulties we will encounter in the actual trading. This is a very standard wedge example, and we did this in the last video. It is wrapped by a trend line and a channel line to form a wedge shape, but we rarely encounter such a standard wedge in actual trading. Most wedges consist of 3 pushes, and as long as the 3 pushes form a shape similar to a wedge, we will trade as a wedge. First, I often say that a form of failure will immediately form a new form of structure. Before the market is finished, we do not know which structure the market is doing. How to understand this sentence? We look at the linear adjustment in the figure and the market has already put the shape out. Now, in hindsight, the wedge is pretty obvious and the entry position is pretty clear. But if we remove the K line from the back and the market gets blurred again, we don't know what's going to happen with the wedge. Let's start with the current state of the market and look at the context of the big cycle. The big cycle is still in a bullish trend. First, there is a rush and then there is a narrow channel. Then the narrow channel is followed by a broad channel. Biochains are also present here, but the broad background bullish trend remains unchanged, with prices now close to a horizontal band of support. So here we're going to have a long trade logic, and we're going to look at the details of the subcycle. What we can see is that there has been a sharp downward movement in prices, which has been very steep and has approached the previous band horizontal support level, and there has been a significant rebound, which can be interpreted as a correction of the downtrend which has been followed by another sharp decline. We often talk about the price of rapid movement is easy to cause the exhaustion of kinetic energy. The rapid callback followed by a period of rapid is so that the price again broke in front of the small band point. The price again broke in front of the small band point, immediately rebound. This is a sign of the exhaustion of momentum. Even though we're not looking at any indicators right now, we should know that there's a divergence here. Let's look for it, whether it's MACD or RSI. If it's MACD and we look at the 2-hour period, we can see that the energy column has started to diverge. If we take a look at the RSI index and remove the MACD, we can also see that the price of RSI is significantly lower in 2 hours, or we go to the 1-hour period, and the divergence is more obvious. The so-called divergence refers to the lack of trend momentum. We can see it directly from the K line, without looking for it in the index. A lot of non-trend K lines, and then a big overlap which represents the energy of the bulls. The strength of the bulls did not extend as prices slowly rose. We have to be cautious when this big negative line comes out, and for the bulls we see the market in this state, which is very negative for us. This is the first leg up, this is the second leg up, and the second leg up is terminated on such a signal, which is a sign that the bulls are very weak. If you're a long trader here and you're a short-term price trader like me, and you're trying to manage your order, you're probably going to recognize a little bit of a loss here and get out. Don't wait for the market to reach your stop. As we continue to watch the market move out of the third leg of the decline here, we know that it is doing a wedge. We will be trading according to the new logic. Let me get rid of these lines so it looks a little messy. Is there anything wrong with the logic that we used to judge the market to make a 2-step adjustment? No problem at all. So you can go back and listen to my logic. Based on the market conditions at the time, we concluded that this was the most reasonable outcome. It's just that our logic was rejected by the market, which happens all the time in trading. If we knew in advance that he would make a linear adjustment like this, would I still be long on the first 2 adjustments? Of course not, but I can't know in advance that the market is going to get out of this wedge. It's only after the market rejects the logic of a 2-step correction, like this negative line that I just said, that we know that the market is going to move in a new direction. If the market moves sideways after the previous 2-step correction, it goes straight up. Is there nothing wrong with this wedge? And if this wedge continues to break down in search of a deeper position, is this wedge going to fail? And that could happen. We can't move the market and we can't predict the market. Therefore, if I directly present a cycling channel that is completed in this way, which is completed first and in a convergent form, to talk to you, I may not be able to achieve a good learning effect. What I hope is that you and I will learn to master their own trading technology at the end of the study rather than just the ability to analyze after the fact. Secondly, for traders of different styles, they have different logic in viewing a pattern. For example, traders like me are always in the market style and will always pay attention to what shape the price movement appears. Therefore, I may participate in a short sale when the bull flag fails in the first 3 paragraphs. Here's a simple Chanticleer adjustment that I might also be involved in. So here I see that the second leg of the decline has run out of momentum and validated the support level, and I'm going to go long again and do it as a 2-step pullback. I would also trade it as a wedge later if I saw that the bulls had failed to follow through with a third leg down. If you want to operate like I do, you have to understand the price behavior deeply and have enough experience in trading. Half the level of trading will only in the rapidly changing market movement one mistake after another accelerate the speed of the liquidation. But let's say you're only going to trade in a state that's already gone like this, where the market has already gone through the wedge and then you decide to go in and you don't care about the volatility in the front of the trade. It's a very simple way of trading. You don't care about whether the 2-stage pullback is successful or not. If the 2-stage pullback is successful and the price just goes up, then you don't care about it. If the 2-stage pullback fails and you get out of the 3rd stage, you trade the wedge. The same goes for putting it in the convergence pattern and the writing channel. Wait until the market clearly moves out of the pattern you want to do before you trade. Now, we're going to talk about how to trade this wedge, and there's a conservative entry and an aggressive entry. And if you have a more aggressive trading style, then you can register your entry at the aisle line, so let's get rid of that line because it's too messy. This is the left side trade, and if the wedge ends up holding and you enter at the channel line, it gives you a very good profit/loss ratio. We can see if you want to make a wedge, your goal number 1 is to get at least this band point right here with 70 more points close to 80 points, and your stop loss is less than 20 points. He gives you a very good break-even ratio. But if you place your order at the channel line and enter on the left side, the success rate decreases, because the pattern doesn't work until this wedge is successfully broken. You don't know when you enter here if this wedge is going to go uphill. How do we register at the aisle line? So when the price goes like when the price moves here, you have to connect the 2 bands low, and I also recommend that you pay more attention to this channel line in your trade. Remember what I said last time? Your trade is still strong in the long run. You can also choose to break out of the trend line, but that's not the way I like to enter. I can say a couple of things. 1. You can't find the exact trend line. The wedge that I'm picking right now is a pretty standard wedge, and you can see that the 3 points are connected, and there are fewer shadows at the 3 points, so you can fix a line, but you can think about it. When you draw a trend line, do you often come across multiple lines with multiple solutions? For example, each band point has a long lead. You can connect the shadow line to the entity or the image entity. You can connect a lot of these trend lines, and you can't determine which trend line is the one that is really effective or the one that is really broken through. That's the first point where you can't find the exact break. The second point is that it's very easy to make a false break. For example, here the line is already fixed and you break the line and enter directly, so if he makes a false break, he will trap you directly. Third, it's very difficult to put a stop loss in this way of working. So let's take an example. Here we see a break here. Let's say you come in. Where do you put your stop loss? We're looking at a fairly rapid rally where there's no price concentration in front of us and we're a long way from the band, and the logic for putting a stop loss based on the technical level is 2 things. One is that there's a price concentration in front of us, so if you go long here and this is your price concentration, you put your stop loss down here. The second thing is to set your stop at the front of the band just like this. If you come in uphill here, You have to set your stop loss so far and your profit/loss ratio is so much lower that you lose the advantage of doing this pattern. And there's another way to set your stop loss that is used by an expert trader, like this K line where he comes in and he sets his stop loss below this K line. In his opinion, if the K line is broken, then the breakthrough has failed. But what we can think about is, if this breakthrough fails, what does that mean that the wedge fails? So this wedge, it's probably going to go sideways for a while and then it's going to go up. So when you narrow your stop loss and increase your profit/loss ratio, you're going to decrease your win ratio. You can't increase your profit/loss ratio and increase your win ratio at the same time. What about the person who chooses to break out of this trend line? I have two suggestions. The first suggestion is that it is best not to enter above the trend line, but to enter above the previous bands, such as the small bands we see here. If your price breaks through the front of the small band, when the entry will be a bit more conservative, because the horizontal support resistance effect is always better than diagonal. The second is that you can also choose a pattern of a breakout pullback breakout, such as an upward breakout here, and then the price has a brief sideways or small downward pullback of 1 or 2 K lines. And when the price breaks this K line high again, you enter the price through the breakout. The short pullback continues to run in the same way as the breakout, which increases the success rate of the breakout, and your stop loss is set below the small band point of the pullback so that your profit/loss ratio is appropriate. If you're a conservative trader, you can wait for a breakout. We see you can wait for a pullback after a breakout to get in on the long side. That's the right side entry. The westbound route has been confirmed broken, your success rate has increased, but at this point you may have lost the break-even ratio. You don't have a higher break-even ratio than the person who entered here. Sometimes he won't give you the trade back to the test, there's no way around it. You enter to the right and you enter conservatively and you improve your success rate of trading, and you get a good break-even ratio, and you enter into a pullback in a better position than the guy who broke out here. And you get a good win ratio, and you have a good break-even ratio. So your chances of trading are definitely going to be reduced, and there's no way around it. That's the trade-off you make in the actual trade. And the two things that you look at, one is that the pattern changes in real time as the market moves, and you don't know which pattern the market is doing until he finally walks out. Whether it's a two-step correction or a three-step correction, you don't know until he's done. Second, everyone has a different trading style, so if I only talk in one way, I may not be able to meet everyone's needs. So I decided not to talk about each form individually. For example, I will pick a few wedges that have been completed like this. I will not talk about it, but you can feel the formation of these forms in the actual market movement. This will be a little more complicated to learn, but it will give you a better understanding of market movements. If you don't understand the first time, you can repeat it several times or leave a comment below the video to ask me. You can enter our member group and communicate with me. We're going to have the rest of the time to go over the pattern of callbacks that we saw earlier. So let's see, let's just go from here and get rid of this trend line. Let's take a look at this chart. First of all, it has a background that was previously analyzed as a bullish trend, and now it has been adjusted and the bullish trend has been continued. Now the bull trend is showing a lack of momentum, that is our mature divergence. How do we judge? First of all, this is the first leg of the rise. Then we plot the second leg of the rise. We can clearly see that the energy of the second leg of the rise is weaker than that of the first leg. Let's check it out on the index, which is pretty simple. If we look at the MACD, we see 30 minutes, we can see a clear divergence signal on the 30-minute MACD. Let's look at RSI again, and the same thing happens on RSI. It is more obvious in 1 hour. We can see that the RSI of 1 hour has not reached a new high, but the price is at a new high. However, we find that we can also judge the weakening of this trend energy and the divergence from the K chart without the number 1 indicator. I hope that you can learn this way when you review yourself, to get rid of the shackles of indicators. When the price diverges, it simply represents a lack of energy in the trend, and the lack of momentum in the trend can lead to a correction or a reversal. Adjustment is also divided into lateral adjustment or countertrend fluctuation adjustment. A lot of new friends, when they just learn to deviate, think that deviate then reverse deviate to do the reverse trend, which is very wrong. There's a saying that novices die of betrayal, and that's what it means. He's superstitious about such indicators and uses deviation as a divine indicator, which is totally wrong. A divergence simply represents a lack of momentum in the trend. A lack of momentum can lead to a correction or it can lead to a reversal. And reversals are rare. For example, now that we know the background of the market, the big background is the bullish trend, and now there is a lack of momentum, we should pay attention to how to adjust the follow-up. If the adjustment position is relatively deep, we will be involved in the multi-order. Let's mark the horizontal position in the front at this time. It may be our reference point in the back. We look at the follow-up market, we can see that the price has been a relatively rapid decline, a kind of adjustment can be. But it doesn't give us a signal to come in. Why? Because we judge that the rise should be at least as low as this band point, because the trend has shown a lack of momentum. At this point the bulls will slow down the rhythm of its attack, the bulls will only continue to move in deeper position to continue to push the trend up. So looking at the price movement up to this point, we don't think it's wide enough, and he doesn't give us the signal K line to participate in this long. We can see that from the fall, he did not give us any K-line form to participate in a long position, no second break and no good reversal of the single K-line. When the price movement to here, it is even more such a large number of overlapping K-lines. So we're not going to participate in the trade for now. We can see the price quickly break below this front band point. At which point we may have to wait for a long position pattern. If it immediately rises, it is a false breakout to the front band point. A false break to the front band low in the bull trend is the best time to get involved in the multi-order. If we look at the subsequent K line, we just saw that after the left and the left of this K line is pulled in, the next few K lines are overlapping K lines, and we said that the overlapping K lines represent a trading range, which does not give us a good entry pattern. But there is actually an entry logic I can talk about. This logic is not very easy to operate, but you can broaden the thinking of trading thinking. And the pullback is a pullback from the bull trend, so we're going to trade on the long side, and at the end of the pullback there's a trading range, and that's when you can combine the two. It's a trading band in a small period, and the trading band is based on the principle that you can trade at the bottom of the trading band, and you can expect the upper break of the trading band, and the upper break of the trading band is the end of the correction pattern. Does that make sense to you? And this trade is very break-even. So let's say you place an order here and you don't place an order at this level and the height of this interval. Let's say the height of this interval is 15 points, so you drop a stop loss of 15 points, right? Then your profit will be at least 40, 50, 40. So you're on the trend side, and you've got a good break-even ratio, even though you don't have to have a good win ratio like if you have a 50% win ratio. But if you have a break-even ratio like that, then you're statistically very logical and very advantageous. Just to mention this entry, it's not easy to master. We continue to look at the back of the K-line trend. We at this time to extend the following band point. Good pause a little late, but you can understand. We see that after this period of decline adjustment, after that, the price continued to rise, but the rise did not break the previous high, so it is still in the state of adjustment. How can we understand the decline in the second period? We can understand that it's a two-stage callback. And this is the first big callback, right? So even though we have a bunch of little segments in the first segment, it's basically a big decline. So this is the second segment of the decline, and this second segment of the pullback, what does it give us as a validation pattern? We can see that let's get rid of the K line. There is a downtrend in front of this, so this rise you can understand it as a correction of this fall, and this fall is a continuation of the previous fall, and this second fall is a fake break from the previous low. Can you follow it? And this signal K line is the inverse K line that we're talking about, and although it overlaps a lot, the part that it doesn't overlap is very long. It also validates this breakout level. This dip at this signal K line tells you that the previous low is a false breakout and validates the previous breakout level, and it's a two-stage downside adjustment. so you can directly participate in the long side here. Can you follow the logic of this verification? If we look at what's going to happen in the next price, it's going to be pretty easy, but anyway, even getting here gives us a pretty good profit target. First of all, the original market background is the bullish trend. The bullish trend broke through the previous adjustment interval, and the momentum was insufficient for a callback. However, the first large section of the callback did not give us a good entry form. The second leg down has a false break to the previous band low and validates the previous video level and is a good entry signal K line. So here we go in to continue the original big direction to participate in the long. Let's get rid of the lines that we drew in the front so that we can read them later. And let's keep looking at the price. Let's stop here. We can see that this strong rally is a continuation of the bullish trend after the previous correction. But this big rally we can see three small pushes, and these three small pushes we can see visually that the momentum is getting weaker and the breakout margin is getting shorter, which represents the potential for a deep correction. And we are ready to give us an entry signal after the deep pullback to build this multi-order into this bull market. After all, the overall market backdrop is still bullish trend. Let's see what happens next. We can see that when the price moves here it can be interpreted as a downward adjustment. You can also interpret it as two segments, but I'm not going to talk about these subtle price changes here. We can interpret it as a downward adjustment, but what happens here is it doesn't really give us a good entry pattern, the entry K-line pattern. Some people might interpret it as a double K-line reversal. If you look at it by definition, it's a little bit like. But we can see that the positive line on the right is the second K line of the double K line reversal, with a longer upper line. This is a sign of hesitation in the market that at the close of the K line, the bulls did not strongly control the K line. Even if it is an entry signal for us, its stop loss is too long. If the K line is very long, we can see that the stop loss is more than 20 points. Even if we get to the top, it will be more than 20 points. Without a good profit and loss ratio. If you're going to do this, which I don't recommend. If you really want to do it, should be in the middle of the K line to enter the entry, so that you have a better entry position, may win some profit and loss ratio. Let's continue to look. We see when the price movement to here can clearly see two big downward adjustment, and this second downward adjustment to the previous band location has a false break. It is a logical entry point, but it does not give us a position to enter the K-line pattern. How to understand? If we look at the short trend K-line on the left, in hindsight, it is a short run out of energy K-line. It is a selling high, but it is followed by an inner long K-line with a long shadow line. This long shadow line still makes us hesitate about the direction of the market. It is not a good entry K-line. If the second inner package is a small long entity K-line, that may be a good entry position form. Let's stop here. Let's get rid of the K-line at the back. There's a little bit worth talking about even though we're talking about pullback patterns. There's a good reason to be short. Let's plot the horizontal levels of the previous bands. We can see a continuation of the rise after two periods of big declines in prices, two periods of rises. This is the first period and this is the second period. The rise in the second period, as I mentioned again and again in the course, is the continuation form of the correction. The rise in the second period is the continuation of the rise trend in the first period, and the continuation form has stopped at the previous band point, which is the expression of the lack of rising energy. Here is the logic of your first short position. What about the second point is that we've seen a horizontal level of the two-band point verification in the first two times, and again in the third time, and the verification pattern is 5 overlapping crosshair lines, which is a barbed wire pattern that we talked about earlier, a pattern that is not suitable for trading, but this pause demonstrates the weakness of the bulls and it represents the weakness of the second leg push as well as the weakness of the horizontal resistance. Shorting here is logically a very good trade. We continue to look. The same price drop after still did not give us a good entry K-line shape. Let's see when the price moves here. These two overlapping K-lines are very long. And this long overlapping K lines is characteristic of the trading range, and we can't make a position pattern based on these two K lines. It's followed by a lot of overlapping K lines, not a very nice platform to build positions, and if you want to build positions, just recall what I talked about a little bit earlier in the course, which is that you judge the big direction that allows you to go long, which creates a trading band at a small level, and you place an order at the bottom of that trading band. It's a small trading range that validates the big direction, and you go long and you place orders underneath, so that's good trading logic, but it's very difficult to master. We should pay attention to its upward breakthrough at this time, because it has formed a verified trading range here. This trading period box, it is also our kind of finishing form to the trend direction when we can break through it, that when the price movement here, we should pay attention to. As I mentioned earlier in the course, I personally don't like the idea of going straight through resistance, like now, when you have horizontal resistance and you go straight through it and you get caught, it's very easy to get a false break, because the price is moving rapidly. What breakout patterns do I want to trade? Like, don't you have overlapping K lines in front of you? So if the price movement comes up here and instead of a sharp rise, it does this overlapping K line again at the top of the interval, and it has a buildup of pressure before the breakout, and I'm going to participate in it on the upward breakout. But it is not impossible to trade when the market is used here. Some of the people who are directly long are getting caught up, but we can see if we can get back into it if the price is not too weak. Let's see. The second one is still a breakthrough continuation of the K line, is still not the K line I am willing to trade because I do not have a good support point to enter. I hope to see a small pullback, such as the negative line, now I will pay attention to. If he breaks any higher, I might be on the multi-order. Let's look at this K line again, it's going too fast to stop. I've got rid of the back break here. The first negative line is a pullback and the negative line is a breakout pullback. You can also think of it as a breakout failure, it doesn't matter. Now, as an aside, and I'll talk about this a lot more in the future, is the pause that happens after a price break. So if you have a 5K line pause here, whether it breaks a pullback or breaks a failure, it's up to the trader to decide. The pause after the price break, the pause where you don't know whether it's a success or a failure, it's only when it clearly breaks the pause that it breaks up and then it breaks back and then it breaks down and then it breaks down. Some people say that maybe you can judge the breakthrough and success or failure by the combination of volume, but I will tell you that a lot of this combination of volume. The success of the breakthrough is mostly an afterthought, and I personally have studied for a while that volume is not particularly useful. So let's move on. The first negative line calls back the K line, and now there's a second negative line with a lower shadow. As a price behavior trader, this is the ability we must practice, and this ability is also a very important point in the future when we go to reverse the form. I hope you to learn to understand that the so-called deviation is the momentum of the trend is insufficient. So here we have the first rapid fall, and here we have the second fall. We can clearly see that the second paragraph is weaker than the first. That's when the second leg of the decline dries up, and that's a signal of divergence, which I rarely call divergence, and I usually call it a lack of momentum. A sharp decline in the context of a large bull trend followed by a sharp decline in the context of a pullback, and a sharp decline that happens to hit horizontal support and diverge and run out of momentum is a very good logic for us to go long. We are here to judge that the bull trend may have finished its finishing form after these two stages of pullback and will continue to move in the direction of the original trend to test the former high position. Looking at the subsequent market action, we pause here and we can see that the strength of the bulls has not been sustained. Recently, a lot of people have asked me if I am still not sure what this combination of various K lines represents. Let's make a quick interpretation here. When these three positive lines appear, we believe that the downward momentum has dried up, and we need to verify our strong bullish judgment with the follow-up of sustained bullish forces. But let's take a look at the K line. These three overlapping K lines, we talked about overlapping K lines representing a trading range representing a pause in the market, and after that the market immediately put out a long negative line like this with a long lower line, which is good to think of as a second test of the low. but later in the move we can also see very weak. So at this point, you have two ways to participate in the long. The first point is a little bit of conservative price to break through the front constant point when you go to do more, because when the price is again used to band chain above it is a clear breakthrough callback. Breakthrough of form is a breakthrough confirmation form. So you're the more radical one, aren't you? Directly on this negative line, directly on the breakthrough single at the high point, directly hanging breakthrough single. So this is a little more aggressive because prices can still go up and fake break and then come back without breaking the high. But that's the way some people trade, so we're not going to comment on that. Let's say that here you see a pullback and you keep clicking on the breakout order in the front and then the subsequent movement of the price, and he goes up again and verifies the breakout pattern, and then we come in and we put a stop below the breakout, but the order is actually not very good. He makes a gray dot this long and our stop loss is so far away that it doesn't look like a very good advantage. It's only 40 points. It would have been great if he had only recovered here a 20-something stop loss space and then the stop gain, because you're making a break in the trend direction and you probably don't have a very low break-even ratio. Let's finally sort out the trading logic of this pullback pattern. You can understand that it is a three-stage downward adjustment. In fact, in my system, you can call it correlational. Although it looks very unlike correlational, you can also think of it as a trading zone or box. It doesn't matter. What matters is that it is an adjustment pattern. Let's start with a big rally on the left, which is a continuation of the bullish energy, but this rally is made up of three small pushes that are getting weaker and weaker, so a deep pullback is possible. We did not find the K-line pattern in the first pullback. In the second section of the fall, did not find the position form. In the two falling bull extensions, the bull's energy stops near the band point, indicating that the consolidation pattern has not yet completed its third downward push, and these three pushes the move establishes a trading band. We do a break in the trading range and it's best not to get involved in it when it's breaking fast, because it's easy to fake a break, but I'm not saying it has to be false, but it's easy to fake a break because it's breaking fast. We'd better see a sequel with pressure before a breakout or wait for a breakout pullback before a breakout pattern. For example, in the breakout phase we have a continuation of the positive line and then immediately a pullback of the negative line, a pullback of the two negative lines. We put a breakout order above the breakout band high and a stop loss below the breakout band low. We are very conservative in trading this range break in this way. Okay, so that's it for today. And the next video or two is going to be just like today.